I'm Charlotte McLeod with the Investing News Network, and here today with me is David Garofalo, President and CEO at Gold Royalty. Thank you so much for joining me here today. We're in Florida, very excited to see you.
I'm excited to see you as well. Thanks for having me on.
Yes, of course, and I think it's great timing for our conversation today because we had just yesterday the latest meeting from the U.S. Federal Reserve. We got a 75 basis point rate hike, which I think was widely expected. We have spoken before about this, and you've told me, eventually at some point the Fed is going to need to reverse course. I know it's hard to predict when that will happen, so I'm not going to ask that, but I think maybe we could talk about catalysts. What could catalyze that turnaround?
Well, I think the GDP numbers that came out this morning technically put the U.S. into a recession. So 2 consecutive quarters of contraction. So I think the day is coming when the Federal Reserve will have to pivot and start to talk about easing monetary policy again, or at least stopping the tightening cycle. I think it's inevitable given the amount of debt that's been strapped on the economy. It's more than 3 times what it was in the last big inflationary cycle in the 1970s on a per capita basis.
Right, and let's dig into that recession question a little bit more, because Powell in the press conference after the meeting yesterday was really questioned quite heavily on whether we're in a recession. He said no, and as you mentioned, we got those GDP numbers today. So why is this such a tough question to answer?
Well, I think he's concerned about perpetuating that and affecting consumer confidence, affecting confidence in the markets. And so they're avoiding the R word. The Treasury Secretary, Janet Yellen, is avoiding that word. But unfortunately, we are technically in a recession right now in the U.S. And so they're going to have to do something to ease concerns in the marketplace. And we've seen a severe correction in equity markets. We've seen a contraction of earnings as well, which could lead to another leg of correction in the equity markets. And that could end up into a bit of a vicious cycle. I think that would hasten an even more severe recession. And again, given the amount of debt service that consumers are having to take on, governments are going to have to take on as interest rates go up on a nominal basis, I think eventually that could lead to a very, very deep stagflation.
Right, and so after this news yesterday, we got a little bit of an increase in the gold price, although when we were speaking last in May, we were talking about, the markets are going down, that's dragging gold with it. And we also, since then, we've got the strong dollar that people are talking about hurting gold. So what on earth is going on with gold? What are the main headwinds that you see right now?
Well, I think it's a lack of confidence in fiat currencies generally outside of the U.S. Gold, interestingly, is achieving all-time highs in virtually every other currency, major currency in the world, other than the U.S. dollar. So there's been a flight to both the U.S. dollar and gold. Gold's retained value in the face of a very severe bear market that we've experienced this year, with equities down 10 to 20%, depending on what major market you're looking at. So gold has really done its job as a store of value, but it's likely to accelerate upwards dramatically as inflation accelerates. Because the reality is nominal rates have very limited scope for increases, and inflation will continue to accelerate for the foreseeable future, in my view.
Well, this is one of the things I really wanted to touch on with you today, because I know you're very bullish on gold. We've talked about that $3,000 per ounce price prediction during this cycle. And I know that, fluctuations like we've seen don't really bother you, but people, like we've been talking about at the show here, people are feeling jittery, is how we were saying before this interview. So what would you say to those people who are looking at this and feeling, a little bit worried or unhappy about what's going on?
Well, look, I'd say the dynamics, the fundamentals for gold is as strong as they've ever have been, and we just have to look at the last big inflationary cycle to see how gold will perform at the outset of this type of inflationary cycle. It took a couple of years really for gold to gain traction back in the late 1970s and early 80s before it achieved its all-time real peak of what today would be close to $3,000 an ounce in 2022 dollars. And that's because inflation was just starting to take hold back then. And that's exactly what we're experiencing right now. But I think the level of inflation will actually be unprecedented in this cycle because, again, the amount of debt that's been strapped on globally by governments, by consumers, by corporations is unprecedented on a per capita basis. So there's very limited scope for central banks globally to really raise interest rates on a real basis. Back in the late 70s, Paul Volcker actually increased rates to 20%, well in excess of inflation in order to tame inflation. There just isn't the scope for central banks to do that now. You're not going to see nominal rates go above the inflation rate again. That's just not going to happen because the debt service costs would be unsustainable, even for the US government.
And would you put a number on where inflation is going to go? Because of course we have official numbers, we have where the much higher number where it really might be. So what are your thoughts?
Well, if you're putting food in your stomach, fuel in your car, a roof over your head, it's not 8-9% headline number. We're deeply into double-digit territory. That's the reality on the ground. And given that debt service costs are so high, mortgages are up 50 to 80%, mortgage payments on a monthly basis, that means more and more of our disposable income is going to those basic necessities. So inflation is biting very, very hard, particularly for the lower income individuals within our economy. So it is very, very severe. And I believe gold is going to start to reflect that in the very, very near future.
And okay, so speaking about how inflation is impacting people in their day-to-day lives, it's also having an impact in the mining sector. We had this week results from Newmont, which I think were disappointing for people. We saw share price go down, and they pointed to inflation as at least part of the reason why this is happening. And I know we've talked about how you have turned to the royalties business because of you believe that's the better bet right now versus being at a gold mining company. So is this the kind of thing that you are afraid of seeing?
Yeah, look, it's a parade of bad news. It isn't just Newmont.
Sorry to pick on them.
Yeah, there were a number. They're the biggest, so why not? But there are a number of mining companies even reported this morning with big cost increases beyond what most analysts had been predicting. So it's a very, very tough environment for operators because gold, while it's been stable, has been flat. And so they're seeing their margins contract, and to the extent they've committed significant capital to new endeavors, whether they're expansions or new mines, it's biting right now. It's really biting into their returns, and so that's undermining investor confidence. And again, I think we accurately predicted that when we entered into the royalty space. We said, we don't want to be back developing and operating mines in this environment. Inflation is coming. It's a wall. It's going to hurt the sector, much like it did coming out of the credit crisis a dozen years ago when gold flew, but input costs flew up with it as we were in the midst of the Chinese super cycle. We didn't have the backdrop of inflation in the general economy then, so this is going to amplify the bite on producers this time. And the reality is, after a decade of underinvestment in exploration and mine development, just to survive, mining companies are going to have to deploy capital on those fundamental things. And that's going to, again, amplify the cost inflation risk. So the beauty of our business is we own almost 200 royalties, but they're completely bought and paid for. And we're benefiting from the fact that our operators are investing almost $200 million on 700,000 meters of drilling this year. So we get the benefit of that without having to pay for it. We get that upside. And that's why royalty companies perform so well relative to the commodity and to the producers back coming out of the credit crisis, because we were in the middle of an exploration cycle coming out of the credit crisis with juniors accessing capital markets. Reserves grew and peaked in 2012. The royalty and streaming companies got the benefit of that while insulating their shareholders completely from inflation.
Yeah. So I guess this is another thing that's definitely difficult to produce, but for the mining companies that are facing these inflation problems, where do they see relief? Because we've got high inflation, we've got a lower gold price. Do we just need to see that higher gold price eventually that will help them out?
That will help them up, and a rising tide floats all boats. And it's not to say that producers won't see appreciation on their stock prices. They've been so beat up over the course of the last couple of years in this flat gold price environment that it's inevitable that their margins are going to, not their margins, but their multiples, will start to expand again to more normal historic levels. But they'll still underperform, I think, the commodity, given their cost inflation, and I think they'll underperform the royalty and streaming companies that are insulated from that kind of cost inflation.
Right, and let's make sure to talk about what's coming up for Gold Royalty this year. What catalyst can we look forward to?
Well, Beaufort, one of our royalty partners, just started up operations, and it's Monarch's mine in northwestern Quebec, poured their first gold this week, and so we're going to start to get royalty checks from that. We just announced that we have a royalty on the Borden gold mine, which was a mine that I built when I was running Goldcorp in northern Ontario, and we just got a back royalty payment of about $1.7 million, and we're going to get ongoing royalty payments from that. So we now have 8 cash flowing royalties in the portfolio. We have another 20 in various stages of construction and development. So that underpins 60% compounded annual growth in our revenue over the next 5 to 10 years. So it's a lot of growth organically. And then we have all that optionality in our other 160 plus royalties from early stage exploration right through to mine development. And as I said, that we have exposure to 700,000 meters of exploration drilling this year on those almost 200 royalties. That's a lot of catalysts. It's a very catalyst-rich story with a lot of exploration potential. We're already exposed to almost 100 million ounces in the ground in our royalty portfolio, and that's poised to grow as a result of that exploration.
Very promising. As we are wrapping up, are there any final thoughts that you would leave the investor audience with in these very interesting times?
Well, I'd be selective, but this is the time to buy into gold equities, and in particular, I would say the royalty companies, and I would say selectively on the exploration side, because out of existential necessity, the producers need the juniors to be successful again, and the ones that have delineated resources are likely to be taken out by the producers who are project starved, reserve starved. We saw Great Bear taking out pre-resource, a very promising project in Red Lake. We have a royalty on Wallbridge's Fenelon project. That's a 3.6 million ounce resource that's poised to grow dramatically next year after drilling 120,000 meters this year. We feel very optimistic about that one. We're watching that, but there are stories out there. And I think if you pursue a barbell strategy in this industry, if you believe in gold as an asset class, in other words, buying royalties at one end of the spectrum and selectively buying the exploration companies that are likely to be taken out by the producers, I think you'll do very well. You'll get outsized returns.
Okay, well, that sounds like a great note to end on. Thank you so much for coming by to talk today.
All right, thanks for having me on.
Of course. Once again, I'm Charlotte McLeod with the Investing News Network, and this is David Garofalo with Gold Royalty.